When investing in the stock market, it's important to carefully analyze a company's financials and valuation before buying shares. While it's exciting to see a stock's price rapidly rising, that can sometimes be a red flag that it has become overvalued and is due for a pullback. In this video, we'll go over 5 key warning signs that a stock may be overvalued and trading at an unsustainable level compared to its fundamentals. Recognizing these signs can help you avoid overpaying for a stock and getting caught up in investor mania or hype cycles. So let's dive into the 5 warning signs that a stock's valuation has become excessive. 1. Extremely high price-to-earnings ratio. The price-to-earnings or PE ratio is one of the most common metrics for evaluating if a stock is undervalued or overvalued relative to its earnings. It shows how much investors are willing to pay for $1 of a company's earnings. While PE ratios can vary significantly across industries, a PE ratio that is double, triple, or even higher than the company's industry group average can be a major red flag. It signals that investors have extremely high and potentially unrealistic expectations baked into the stock price. As an example, if a software company is trading at a PE of 100 while its peer group averages a PE of 30, that could mean the stock has become severely overvalued unless its growth prospects are truly exceptional. 2. Unsustainable growth expectations. Speaking of growth, another warning sign is when a company's stock is trading at an extremely high valuation based on optimistic projections of future revenue and earnings growth that simply may not be realistic. Analysts and investors tend to get overly excited and extrapolate recent high growth rates out for many years or even decades into the future. But in reality, most companies hit a maturation phase where growth inevitably slows at some point. So be wary of stocks trading at nosebleed valuations of 20x revenues or more based on rosy scenarios of 30%, 40%, or higher annual growth rates projected far into the future with no foreseeable slowdown. That's often a sign that the current valuation has become completely disconnected from reality. 3. Severe deviations from historical valuation. Every stock has a typical valuation range where it has historically traded based on investors' long-term views of the company's prospects and risks. So a third red flag is when a stock's valuation metrics like its PE, price-to-sales, or price-to-book value ratios become extreme outliers compared to their normal trading ranges over the past 5 or 10 years. For instance, if a stock has typically traded between 10-20x earnings over the last decade but is now over 30-40x earnings with no major change to its underlying business, that could indicate an overvaluation that is unsustainable versus its historical norms. Stocks can certainly break out of their typical ranges for good reasons like a major positive development. But more often than not, a valuation that is an extreme outlier from the stock's normal historical trading range is a sign it has become overheated in the short term. 4. Low or no profitability. The ultimate driver of a stock's value over the long term is the ability to generate consistent profits and positive cash flows. So a fourth major red flag is when an unprofitable or marginally profitable company has an enormously high valuation based purely on potential rather than actual results. This sometimes happens with exciting new technologies or recent IPOs that investors are incredibly enthusiastic about. But unless the company can deliver outstanding revenue growth while also rapidly improving its bottom line over time, those lofty valuations are often unjustified. So be very cautious about companies trading at nosebleed valuations of billions or even tens of billions of dollars if they are still losing money or just marginally profitable. Those high expectations may never materialize. 5. Extremely low short interest. Our final warning sign is more of a secondary indicator, but it can provide insight into how overstretched a stock's valuation may have become. That indicator is the percentage of a stock's shares that have been sold short by investors betting on a price decline. In normal market conditions, most stocks will have at least a few percentage points of their float being shorted by investors looking to profit from any overvaluation or downside catalysts. However, when a stock's short interest becomes extremely low, like under 1% of shares outstanding, that could mean the share price has become so inflated that even skeptical short sellers are avoiding the name. This lack of short interest means there are very few investors acting as a counterbalance to the buying momentum, setting the stage for an overvaluation bubble to inflate further before inevitably popping. So those are 5 key red flags to watch out for that may signal a stock has become overvalued versus its fundamentals: extremely high PE and other valuation ratios, unrealistic growth estimates, severe deviations from historical norms, low or no profits, and extremely low short interest. Of course, valuation is just one piece of the puzzle, and these are simply potential warning signs, not ironclad rules. But recognizing when a stock's valuation may have become frothy can help you avoid overpaying and identify opportune times to take profits or wait for more attractive entry points. I hope this overview gives you a helpful framework for analyzing if a stock has become overheated and potentially set up for a correction. Let me know if you have any other questions.